Well, risk appetite remained underpinned last week with new all-time highs seen in equities across the globe, from Wall Street to Germany to Japan to all the way down under in Australia, although markets were a little bit quieter elsewhere, with treasuries rallying just a touch, led by the front end of the curve, while the dollar moved sideways once more in what remains a pretty dull and turgid G10 FX market. The week ahead, though, is the week that has it all. We've got policy decisions due from the ECB and the Bank of Canada, plus Fed Chair Jay Powell heading to Capitol Hill for 2 days of congressional testimony. Elsewhere, we've got the budget due here in the UK and a packed data docket as well, with the latest PMI figures, Chinese trade data, and of course, the latest US jobs report rounding out the week on Friday afternoon. Plenty to discuss on the Trade-Off UK this week. Without further ado, let's get into the show. So levels of cross-asset volatility remain relatively subdued in the financial markets at the moment, but perhaps, just perhaps, this will be the week where things spark into life once more. Joining me, as always, to take a look at last week's developments and also look ahead to what this week may hold is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you. How are you doing this afternoon?
Yeah, good afternoon to you, mate. I'm scared. I'm very scared. I was looking at the calendar this morning and everything is going on. Central bankers, budgets, jobs, data, services, more central bank speakers, Powell, UEDA, Bank of Canada, ECB. I think I might hang up the gone fishing sign and come back next week, mate.
Well, before you hang up your go fishing sign, at least we can get through the show. Well, Ryan is scared. I'm excited, I think, maybe nervously apprehensive, but let's dig into that busy data docket and get into topical stuff. Yeah, so as Ryan said, plenty going on this week. And of course, monetary policy remains one of the big themes dominating financial markets at the moment. And I think the central bank announcements and speakers that we've got going on this week are perhaps going to be the key driver of volatility, although I would expect most of this bonanza of policy events to really stick to what is now a very, very familiar script. Just to go through the three key events in a little bit more detail, obviously we've got Fed Chair Powell heading to Congress for his semi-annual Humphrey Hawkins testimony. He is testifying to the House on Wednesday and then the Senate on Thursday. I think we should see Jay Powell really repeat his recent remarks that the Fed are seeking more confidence that inflation is moving towards the 2% target before they cut rates. And of course, the CPI, the PPI and the PCE data that we've had since the January FOMC really reiterate why the Fed are in that data-dependent stance still. And I think in essence, really, Powell is going to stick to what he said at the January presser, in that they're not really in any rush to cut rates. They don't want to run the risk of moving too soon. Of course, financial markets pricing the first cut, or fully pricing the first cut at this point for June, with around 90 basis points worth of easing in the curve for the remainder of the year, which is actually pretty much what markets price for the ECB as well. We've got 100 basis points worth of cuts priced from the folk over in Frankfurt, and we get their latest policy decision on Thursday. Not expecting any policy shifts from the ECB. The deposit rate should stay at 4%, and the guidance should once again reiterate that they need to keep rates at sufficiently restrictive levels for as long as necessary, which is central bank speak for higher for longer. I think there may be some discussion of cuts among members of the Governing Council, but clearly way too early to actually deliver a cut at this point. And I personally shifted my expectation of the first ECB cut into June from April after that hotter than expected inflation figure last week. And of course, Lagarde will stress the data-dependent nature of the ECB. They want to see that Q1 earnings data, but we will likely get a downgrade to the inflation and growth expectations in the latest staff macroeconomic projections. And then just rounding all of that off is the Bank of Canada. We're not expecting any shifts from the BOC. We did have a downside surprise in the last inflation figure. It will be acknowledged, but I don't think it's moved the needle too much. OIS markets in Canada priced the first cut for July with around 85 basis points worth of easing this year. So a very synchronized summer of easing is still priced in terms of these G10 central banks, and also looking elsewhere, such as the BOE. But in the short term, at least, Ryan, out of all of that lot, what do you reckon is the most important that we should be keeping our eye on?
Out of that lot, it's hard to pick. I think they're all equally important, as you say. Everyone's on a seemingly the same path to potential cuts. We're still arguing over when they're going to come. Taking each one as they come. Powell, we had the statement out, or the testimony out last week, so it's pretty much a rinse and repeat of the last FOMC statement. And I think you're right. I think he's going to continue to push the rhetoric with this sticky inflation being seen that they're not in such a rush to cut, and they need this more evidence. I expect bumpy to be one of the key lines in any comments he makes, because a lot of Fed heads have been saying how the path to 2% might now be bumpy. A lot of Fed members brushed the January data under the carpet, really saying, you can't take 1 month as any big thing. But maybe Powell will have a different line on that, because we are still seeing inflation pretty sticky. It's not coming down as fast as it was last year. And as we've looked in prior shows, it bottomed out in July last year. So it's still much more sticky than I expect. The ECB, yet no action from those guys. They got a little bit of, again, stickiness in their inflation numbers last week, which likely will bring out all the hawks saying, job's not done yet. Forget about March cuts, April cuts, and we're going to be moving into the middle of the year. So them and the BOC as well, Fed, BOC, ECB, it's all about the timing now. Are they going to finally give us a proper timeline for all these cuts that they're expecting, or are things going to get pushed a little further down the calendar? And I think that's going to be the sway for markets this week.
Yes, indeed. I think, no, they're not going to give us a timeline. Actually, probably one of the more sensible things President Lagarde has said since she took the helm of the ECB was, we're data dependent, which means I can't give you a calendar as to when we're going to do things, which actually makes complete sense. But of course, just one caveat on all of that, Powell's testimony, everyone in the market sits here and gets excited about it. Just remember, it's politicians in an election year that are questioning the Fed chair. It is going to be ripe for them to try and get campaign opportunities in for their re-election or whatever their pet project is and all the rest of it. So by all means, it's important. By all means, it's a big event and it needs watching. But be prepared to sit through a fair bit of political nonsense while you do so. In any case, we're talking about the timing of cuts. There is one central bank out there where we're talking about the timing of hikes.
Yeah, very much so. Our mates over at the Bank of Japan, and this month, March, could be one of the biggest in decades for what goes on in Japan. We got another taste of the market's appetite for all things Japanese last week. The Nikkei broke, its 3-decade and all-time highs. We've had 2 BOJ members, including the top man himself, giving further insight into how, when, or if they're going to end easing and the ending of negative rates. We'll start off with Bank of Japan's Takata. He said that he was pretty upbeat, saying that the price target is coming into sight. Wages are looking like they'll be higher than last year, but that he hasn't made up his mind on whether they go in March or April when he choose to end negative interest rates. So that was a bit of a hawkish slant, putting March on the table, really. But he did say that the process would be slow when they do start tightening. So a very gradual process, as we know they're looking to do. Now, that put a decent bid in the yen, that knocked dollar yen down into the 149s. Then soon after that, Ueda, he came out with a slightly different message, saying that inflation was easing at a quick pace. So a bit of a pushback there on what's happening in inflation. Also, that he could not see that the inflation target is being met. Again, another little bit of a takeaway from Takata's wind there. That was somewhat backed up by the January CPI data, which showed another drop. It wasn't as much as expected, but it was a drop over last month nonetheless. As I say, those comments took a bit of wind out the sails of the Takata comments. So we move into into March.
You're wishing the year away, Ryan. Come on.
I'm thinking too far ahead of myself. That's the problem. So we're moving into March. We're nearly in May. And it has the potential to be a big deciding factor for the Bank of Japan. This month, we get the huge Rengo Union starts releasing its wage negotiation data, some of what they're getting up to, what they're looking for, what the firms are saying about those wage negotiation levels that they're going to be putting in. We'll also no doubt be hearing from some of the others too. Then on Tuesday, tomorrow, after you've had this, we would have had Ueda speaking. And then we get the first February CPI numbers, they come from the Tokyo CPI, but the first for February. And again, that is going to be very big for the Bank of Japan. Core CPI is expected to break a 3-month losing streak, rising 2.5% versus 1.6% prior. Such a number would be music to the Bank of Japan's ears ahead of this March meeting coming on the 19th. So if you're trading the yen, you need to be right on top of all the news out of Japan. And I've got a question for Michael. Are they going to start tightening? And if so, could they go in March or April?
Give me the easy questions
this time, isn't it?
I like being the quiz master, not the one who has to respond.
Can't have it all your own way, mate.
It's my show. Our show. April would be my hunch at the moment, just because they're probably going to want the data from March, and they're going to want the outcome of these wage negotiations before they do pull the trigger. But what I think was perhaps most interesting was last week was those comments from, and I've already forgotten his name, Takata, where he was talking about the possibility of a hike, but he was really quite explicit in saying that this is not going to be a prolonged tightening cycle. It's more of the ilk of we are going to raise very, very gradually. And actually, I'm going to quote the BOE back in the day, to a gradual and limited extent, which almost sums up exactly what the BOJ are going to do in terms of policy. So I still question the extent to which a BOJ hike is a sort of prolonged bullish catalyst for the yen. I think dollar yen in particular is still much more of a rates trade from the US side of the equation than it is from the Japan side of things. Although, of course, the 2-year JGB did hit its highest yield since 2011 last week at a whopping 0.16%.
Yeah, very much so. And we laugh about it, but it is very important because there's a lot of money sitting on the sidelines from Japanese whales. They've held off purchasing JGBs the last year or so because obviously if rates are going to go up, they're going to get better yield. So there is a flood of money waiting to come in when they do finally start, and hence why the BOJ need to take a very slow approach to make sure there's no market upheaval going on.
Yes, absolutely. And slow is, I think, the only way to characterize what they've been doing over the last decade or so. In any case, let's move on, because it is, of course, Payrolls Friday coming up a little bit later on this week, concluding what is a very, very busy week in terms of economic data. And I'm sure Ryan is going to get onto that a little bit more in the next segment. Overall, the payrolls number and the jobs report in its entirety should again point to the US economy being on course for a soft landing. Although it's worth noting that actually a few people are now out there touting the idea of no landing, this sort of interminable wait for the US labour market to soften in the face of the lagged effects of the Fed's tightening cycle. Just goes on and on and on. And I think the longer it does go on, the more people start to think, well, actually, maybe we're not going to get this slowdown in growth. Maybe we're just going to keep going at the current pace. Now, I'm still in the soft landing camp, but obviously we will see what happens, because, of course, no landing arguably means no Fed cuts as well. And that is probably one of the big risks facing markets at this point. I stress, not my base case, but a risk I think people should be aware of. In terms of the jobs report, payroll is expected to rise by around 200,000 in the month of February. No, Ryan, I'm not going to give you my guess until Friday. Such an increase, that would put the 3-month average of jobs gains at about 295,000, pending revisions, of course, to the January and the December prints. But that would be the highest since March of 2023. So rather than cooling down, the labour market is actually starting to heat up. Unemployment expected to remain unchanged at 3.7%, and that comes with participation likely to rise just a touch to 62.6% in the month of February. But in what will likely be pleasing news for the Fed if it comes off, average hourly earnings set to cool from that 0.6% pace that we saw in January down to around 0.2% on a monthly basis. That will allay some concerns that rapid earnings growth is fueling inflation in the services sector. But in terms of market reaction to the jobs report, I think it's important to recognise that the market, whether you look at OIS or the Fed Fund futures curve and the Fed's dot plot, are now pretty much aligned with each other in both expecting 75 basis points worth of cuts this year. Now, personally, I see it a little bit difficult for the market at the moment to rush to pricing a more hawkish outlook than the Fed have indicated. I think that 75 bips of easing is almost a ceiling at this point in terms of how hawkish pricing is going to get, unless and until the Fed change their dots at the March FOMC. So I would argue, therefore, that actually we may see a bigger move in terms of financial markets and in terms of rates pricing in particular on a miss rather than on a beat, given that, as we said, markets probably aren't going to price out much more in the way of cuts just yet. But as is always the case with payrolls, the data gets revised so many times in the future. Policy is not made on one payrolls report, and actually long-term trading decisions, I would argue, shouldn't be either.
Very much so. I'm going to take the other side of that trade. I think if it's a gangbusters report, we've been threatening it that maybe the market starts to underprice Fed cuts. But on the flip side, it would be just it'd be perfect sense that now that the market is finally in line with the Fed, we get a number that pushes it back out of sync with them again. So, we all know that's trader's luck, as you like to say. For the jobs numbers itself, I think the usual caveats apply. If we're in that 100 to 300K mark, then there's not going to be too many waves coming from that. Wages for me is the important number. That 4.1% year-on-year number last month, I think it was, still showing that wages are on the sticky side of things and remaining fairly hot. Not overly hot, but bubbling along nicely. If we get another upprint there, then that is going to be a problem for the Fed, because then they may be in a bit of a wage price spiral, and then that's something they're going to be looking at very closely. For the rest of it, I don't see any big waves coming. It will be a shock if we finally get a big negative number, if something's happening that we don't know about. But it's given the record so far, it's hard to see one coming. Hopefully that's not a kiss of death. And as for your guess, Michael, well, I wouldn't mind if your guesses were actually close to the mark when they come out, for all the time you take to make them.
Right. I'm not going to turn this into the payroll sweepstake edition of Trade Off, but how close were you last month?
Well, I like to be different. I'll just say that.
I think you were even on the wrong side of zero at one point, not too long ago.
Well, it takes two to make a market, Michael, as you well know.
Well, yeah, that's very true. Right. Well, we'll see what happens on Friday. We'll report back the results of our payrolls guesses this time next week. There's plenty else going on the macro side of things, though, coming up over the next 4 or 5 days as well.
But we spoke about the auto sector last week, beginning maybe to flag some issues about demand, particularly in the EV sector. And since then, we've had some further worrying news from some of the consumer side of the economy, particularly in the US. We already knew that retail sales were negative in January, but since then we've had a poor showing from the Michigan, which in Friday's final release was actually even worse than the flash number. Then we had the main conference board consumer confidence numbers sinking the big chunk too. Durable goods, that came in with negative numbers, even the ones that are core durable goods. And durable is obviously the measure of things like household goods. That was posting a big loss too. Now, obviously, the usual caveats apply in that we shouldn't go all zero hedge over 1 month worth of data. But when all the various consumer numbers point the same way at once, that tends to get my antenna up. So this week is going to be big for jobs. But what I'll be watching for is the more consumer-focused sector breakdown in something like the ADP. That's a sign like retailers, hospitality, leisure sectors are maybe weakening on the jobs front, because then that plays into the consumer side of things as well, because they're consumer-led components. Also, the same for the services numbers. If we get in those sectors showing weakness as well, it's all going to build this picture, perhaps, that the consumer might be on a bit of a wobble. As we're fond of saying on this show, the consumer is a big linchpin of economies. So identifying a trend here can give you an early steer for trading central bank expectations. Now, just quickly, I had a talk with someone over the weekend who's really big in the autos, and we were talking about, record growth last year, all well and good. But a lot of that's been from first and second adopters of electric vehicles, so firms who are making their green switch, climate switch and everything like that. Where the problems are being seen now in the industry is the likes of you and me and the general public. How many people can go out and afford a 60k Tesla or something of the like? So while these numbers have been strong, there's been a reason why they've been strong, and now we're getting into the consumer part of the game to see if whether that strength is still there or if it's going to fall off a cliff.
Yes, indeed. We thank Ryan Littlestone, the trade-off electric vehicles correspondent, for another promising update on that front. On a more serious note, I do think you're absolutely spot on, mate. It is, we shouldn't overreact to one data release. I say that a lot. Policymakers don't. We shouldn't as market participants. But last week, if you do look at that US data in its totality, all of it was weaker month on month, and all of it was just a little bit more of a kind of little amber flashing warning light than it had been in recent times. Durable goods orders, fine. The headline dragged lower because no one ordered any Boeing aircraft, but the core numbers were weaker as well. ISM manufacturing, weaker in the headline. All the sub-indices were weaker as well. And actually some of the forward-looking gauges, new orders, rolling over quite substantially. We had a downward revision to GDP, consumer confidence, all of these little jigsaw pieces you kind of put together and just say, not the end is nigh and go all doom-mongery now. But if that becomes a trend over the next couple of months, do you then start saying, actually, maybe we are looking at, a little bit of a harder landing, or maybe the consumer is struggling a little bit more than we expected? And I think that's absolutely a theme that's going to be very, very important for folk to keep on the radar as we move into, the second quarter, which is only about 4 weeks away at this point.
Yeah, exactly, mate. I'm gonna do something for you now, mate, because I like to put my money where my mouth is, and as I'm such an EV expert now, as you pointed out, I'll tell you what I'll do. If you get closer than me on this week's NFP, I'm going to buy you an EV. How about that?
Yeah, well, it's going to be a little Matchbox Tesla or something, isn't it?
I'm not saying anything. Do you want a bet or not?
As long as I don't have to buy you one, I'll take the bet.
Cool, done. We'll shake on that one later.
Right, now we've finished our betting. Let's move on to That's a Setup. Right, I want to look at gold first of all this week. The yellow metal has found its shine once more. I'll give myself a red card for that pun. But it's always been an interesting one for me, gold, because the drivers of gold seem to change almost on a whim and with little logic or rationale behind them. Sometimes we're sat here and we're talking about gold being a safe haven and it's moving in line with risk appetite. At other times, we're moving in line with the dollar. But right now, it seems like gold is moving bang in line with real yields, particularly real yields at the front end of the curve, which is arguably the classic inverse correlation that you think of when you think of what is a big driver of gold and actually of precious metals more broadly. Now, the idea behind this is that if you have real yields coming lower, and of course that is nominal yields adjusted for inflation expectations over the appropriate tenor, the conclusion that draws is that there is effectively a lower opportunity cost of holding a big lump of metal that doesn't yield anything, i.e. gold or silver or whatever other precious metal you want to look at. Now, if you look at real yields, now these are on the left-hand axis on this chart, so inverted. Real yields have fallen quite significantly of late. Actually, the 2-year real yield touching its lowest level in about 9 or 10 months into the close on Friday. And the reason for this is because we've seen nominal treasury yields rallying. We touched on the fact that the market is pretty much in line with the dots. So we've seen a rally in the front end of the nominal curve, 2-year yields coming lower. But at the same time, we've seen market-based inflation expectations begin to move higher. And actually, the 2-year inflation break-even closed at nearly its highest level in 12 months on Friday. So when you couple those two things together, the market getting a little bit more worried about sticky services inflation and the market not wanting to price in much more of a hawkish path for the Fed, what you get is a big move lower in real yields. And of course, that naturally turns into quite a boon for gold. And of course, the momentum then spirals and actually looks set to take us closer towards $2,100 an ounce, which of course we briefly popped above towards the back end of 2023, but couldn't quite get there on a closing basis. Perhaps we will this time around. And I think actually in the near term, the path of least resistance probably continues to point higher for the yellow metal. But I would caution that it's only going to take 2 Fed officials to move their dot higher at the March Fed meeting for that median dot to go from pointing to 75 basis points of cuts to pointing to just 50 basis points of cuts this year. And obviously, if that does happen, yields are going to move higher, treasuries are going to sell off, and you would expect gold to struggle a little bit as well. So the gold bugs should have a couple of good fun weeks, but then I would be perhaps exercising a little bit more caution as we move into that March Fed meeting.
Yeah, and that's going to be a pretty good call, that 2100, because I've just looked at the price and we're trading 2096. So,
I've really stuck my neck on the line there, haven't I?
Exactly. You really put one out there, Michael. But yeah, we'll see if you get to hit it. But yeah, I agree with everything you're saying there. One thing that we have to know about gold at the moment is really moving on the geopolitical risk as well. And just to show that we have got our fingers on the pulses here, we're having headlines today regarding this Germany stuff where they, I don't know how it's happened, they had a intelligence call among their allies and on WebEx or something, and Russia happened to dial in as they wanted to. No security measures, listen to the whole thing. Putin's now been out moaning about it, saying, here we are, we've got Western people with boots on the ground, UK troops on the ground, and he's, threatening Germany and all sorts. That's probably why we're seeing right now a tick up in gold up to this near 2100 level. So, yeah, there's two sides to this coin plan at the moment. Like you say, the yields, the returns basis there, but also the geopolitical risk. So this is just another thing in the pot that we've got to deal with this week, unfortunately. But that's what moves markets, so we have to pay attention to it.
Absolutely, as if that pot wasn't overflowing already. You say an intelligence call. I think it was more a lack of intelligence call going on there. But, let's just keep our fingers crossed that no Russians decide to infiltrate a recording of the trade-off and leak that to their state media. I'm not sure they get much value out of it. In any case, let's move on to the S&P 500.
Yep, and this one's looking at the moment, it's absolute technical perfection. Stock markets are still giving the bears headaches as they continue to reach fresh highs and all-time highs in a lot of indices. The S&P is one of those, and it's dancing to the tech in the most perfect ways possible. This chart that I'm showing you now has been a bit of a work in progress because we have no historical levels to rely on. So it's about letting the market build the support and resistance areas as we go. The perfection for this one is that the 50-40-50 area that became a bit of a top back in mid-February became the most perfect support point after the 51-12 highs. Now, the simplest technical analysis you will ever need to trade is exactly what you see on this chart. If you can master this, you can master anything. So what we've had now is yet another break higher and still no signs of a proper top coming into play. Does that mean one isn't coming? Absolutely not. But again, we need to see some far more serious resistance coming in than what we've had so far, or at least some of these key support areas breaking down. So right now, we're already through new highs as we're sitting here again. Right now, the 5100, 5112 area that was that former high is the near-term support to watch, followed by 5080, then that 50-40-50 area, and then likely the big 5K number. So if you want to short this, you need to wait for a similar pattern to what happened in that 50-40-50 area, that series of tops. But even then, you need to be careful if we don't break back down below old support. That's what didn't happen at that 50-50 area. We came down, tested it, absolutely spot on, and then we bounced from there. So you certainly need to be nimble. If you're trying shorts in this one, you need to be nimble in taking the profits because you're not getting those dips, not breaking support areas, and then we're coming right back up again. Now, at some point, we will get a change in trend. But if you read this price action in its cleanest form, you'll stand a good chance of them being on the right side of a decent move. But until then, you've got to stick with the trend. The trend is your friend, and that's the same for a perfectly good reason.
Indeed, yes. Very simple technical analysis, but very good and effective nonetheless. I'm going to cast it to one side and say that rate cuts are coming and say that an end to quantitative tightening is coming. Liquidity is coming back into the markets and should become more abundant as we move through the remainder of the year. And of course, with disinflation underway, central banks have the optionality to cut when they want and as much as they want and provide whatever targeted liquidity they want to anywhere in the market that may experience any sort of financial accident. And that is a hell of a lot to fight if you want to be short risk at this moment in time, I would argue. I'm not saying we can go up in a straight line. I'm not saying there's not going to be pullbacks. Yes, there will be. There may even be a correction at some point, in the next 3-6 months. But for me, given all of that and the fact that the economy at its core remains pretty damn strong. I'm struggling to see a really convincing narrative to be doing anything other than being long risk and buying dips at this moment in time.
Yeah, absolutely agree with that. Stick with it for now. There will be a time when shorts will have their day, but it's just not now. And so now I want to know whether you're going to be insulting our Kiwi friends again, mate.
No, I'm not. I'm going to be well behaved this week when talking about the Kiwi dollar. But what I am going to say is that the Reserve Bank of New Zealand were nowhere near as hawkish as we expected last week with their policy decision. Not only did they not hike rates, as some local banks have been calling for, I think ANZ put in their research note when they adjusted to say that the RBNZ were going to hike. They said something like, to those of you who think we've lost the plot with this call, well, yeah, you have lost the plot, guys, because you couldn't have been more wrong, let's be honest. Not only did the RBNZ not hike, they also stuck pretty much with their prior guidance, saying that rates are going to be higher for longer. And actually, when you look at their forecast, they've lowered the official cash rate forecast path for the next couple of years. So a relatively more dovish decision than markets have been expecting. No surprise then that the Kiwi dollar ended last week as the worst performing G10 currency over the last 5 days. This boded pretty well for my play of the day last week, I must admit, but it is interesting that we stalled out in terms of that decline, bang on pretty much the 200-day moving average, which comes in at 60.75. And it looks like the Kiwi is trying to find a little bit of a base there. So, of course, that begs the question as to where we go next. Now, personally, I'm still pretty bearish. We've got long-running issues with China. The RBNZ are clearly not as hawkish as we expected, and I think the dollar should continue to rally over the medium term, given that US exceptionalism theme that continues to run pretty aggressively through financial markets. But I think it's time to be a little bit more prudent and a little bit more careful, and actually I would take profit on last week's play of the day here from that short position, which was just north of the 50-day moving average, around 61.80. And then if we were to get a closing break below not only the 200-day moving average, but also the prior year-to-date lows, which come in around 60.5, then that's when I would perhaps look to re-enter that position. So being a little bit more careful than normal, the levels of vol in the FX market at the moment remain pitifully low, to be quite honest with you. And I think this is one of those where, if the market's moved in your favor, take that profit off the table, take the risk out of the equation, move on, wait for a better level to get back in if the theory still aligns with your view, rather than necessarily chasing things lower when actually there may not be much point in doing so.
Yeah, well said, mate. I think, you can quite clearly see on this chart, 60-50, 62 is your range to play. So, well done on your play of the day yet for that last one last week. I was looking at Kiwi Aussie, never came to fruition, so I didn't do anything on that one. But the reaction was still pretty much the same anyway. We're seeing the similar patterns in a lot of pairs. Aussie dollar's looking similar as well, where we've had this move off the lows. We made a high. Now we're sitting pretty much in the middle. I'm not sure what kicks us out of it. It's either going to be something strong on the dollar side, the Fed side, that is the big kicker, or there needs to be something big coming from some of these other central banks, RBA, RBNZ and the like. And as the RBNZ have said, we're not likely to get anything from those guys. So really, trade the range for now. Watch for any breaks and why any breaks are happening. If it's because of the Fed, it's going to be something big. That's going to be a break that maybe is going to have some legs. But until then, trade the range, my friend.
Indeed, yes. Right, moving on to our last one, dollar MEX. Yeah,
dollar MEX, not one we've spoken about often, but I'm looking at this one because it's looking pretty interesting on the chart. It's one of probably the most, or one of the interesting policy divergence trades, dollar versus the Mexican dollar. It's interesting because both the Fed and Banxico are expected to cut around 75 basis points, although Banxico is expected to do that in the first half of the year versus the Fed cutting thrice in sort of across the whole year. Now, over at Banxico, the policy deliberations amongst governors are very mixed. So what they do is a bit up in the air. Some are looking for cuts sooner, some are seeing stickiness in inflation, and the whole package of opinions over there is very mixed. Now, if they are to cut 75 pips in the first half of the year, they only have 3 meetings to do so. So the next meeting being 21st of March is going to be the important one for those market expectations. Now, so far, the Mexican dollar isn't really responding by weakening at all. And we're now perhaps looking like we're moving back under the 17 level. It's pretty big level, this one. Now, that would potentially set up a move to last year's lows around the 1660-70 area. So technically, that might be a strong support level if we're in a situation where the Fed and Bank Mexico are roughly moving along the same path with monetary policy, meaning there's no real reason to see a big drop here. However, remember that this is a very strong carry trade for shorts. And as long as that's not in any real danger, you're likely to see big, strong rallies that are still sold into. Range trading is a big play right now. Just said about it in the Kiwi dollar and other pairs. So for me, the 1660-70 to 1850 is the range that you want to be looking at for this one. And maybe if you get a test down to that lower end, there may be an idea for longs.
Very good. Very comprehensive, mate. I think you've pretty much said all there is to say about that one, to be quite honest with you. So why don't we move on to our plays of the day? Right, I want to look at, we're both talking about the euro. Blimey, what have we done here? Right, I want to talk about the Swissy this week. We probably don't spend enough time talking about FX crosses on the show, in all honesty, but I think that's probably going to change as we move into what everyone seems to be calling the summer of easing, or the summer of rate cuts, with G10 central banks going to be cutting at different paces and to differing extents, and that should hopefully open up some nice divergences and a bit more FX volatility. And I think Euro Swissy is perhaps a classic example of that divergence trade, where you have hotter than expected inflation in the Eurozone, that February inflation data that we mentioned earlier on, pushing back the likelihood of a first ECB cut to June compared to April, where we were previously penciling that in, particularly with core inflation still running north of 3%. Meanwhile, although Swiss inflation was a little bit hotter than expected, just by 0.1% when it came out this morning, the February report, we're still looking at CPI in the low 1% in Switzerland. And I think there is perhaps the market underpricing the chances of the Swiss National Bank cutting as soon as March. They meet in just a couple of weeks. Markets currently see that at around a 40% chance. I would say it's probably more of a 60 or 70% chance, to be quite honest with you, particularly with inflation well below target. And also with Thomas Jordan and his colleagues over at the Swiss National Bank, they flagged on numerous occasions some concern about the real-term strength in the franc and the fact that that is likely to cause further disinflation within the economy, which clearly at this point they don't actually want. So therefore, I'm going to be going long Euro Swissy at spot. We had a close north of the 200-day moving average on Friday. We have actually continued to move higher in early trade this week. I'd put a stop towards the bottom of that uptrend and overall looking for a move back north of that 97 figure in due course as we move closer to that SNB meeting, which, if memory serves, is on the 21st of March. Now, Ryan, you've possibly got the shortest notes I've ever seen for this idea.
Well, I like to take the KISS approach, keep it simple, stupid. So that's what I'm doing with this trade. It's a pretty simple play of the day this week. I'm looking for a retest and hold of that 85 zone in euro sterling. This one will be a bit of a question of timing. It's reliant on what the ECB say at this week's meeting. Any dovish sounding comments, maybe firming up or getting the market trying to firm up a timeline for cuts may be a trigger for a down move in the euro. If I see euro sterling down to this support area and it's not breaking, once again, I'll be looking to pick up a long, add back into some current longs that I've still got for a move at least back into the current range, 85.50, 85.70. So yeah, long for me, testing the support, playing the range again and see where we go.
Good stuff, as always. Well, that brings us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Relied and Forex Analytics for joining me. Thank you to Kyriakos, our producer, as well, for bringing this together as brilliantly as he always does. It is a busy week ahead, and all three of us will be back again this time next week to hopefully try and make sense of it and look forward to actually what is going to be another busy week next week. It is a very, very jam-packed March in terms of event risk for the financial markets to grapple with. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets or if there's anything in particular you'd like us to discuss. And all three of us will be back again in a week's time. Thanks as always for watching. Goodbye for now.